Time for me to polish my crystal ball and give you part one of the Renegade Investor's Almanac. It's always dangerous to make predictions. For me, the biggest surprise of 2013 was the continued decline of gold and silver prices despite huge physical demand. The amount of manipulation going on in the paper market for precious metals will one day emerge as a scandal to rival LIBOR and foreign exchange fixing. There's been no real improvement in the world's financial fundamentals, and fiat currencies have been further weakened by money printing on a biblical scale. Now, who was it that said that markets can stay irrational longer than you can stay solvent? A lot of column inches are being devoted to the likely impact of tapering on American quantitative easing by Janet Yellen, Ben Bernanke's successor at the Fed. So far, it's being reduced from $85 billion to $75 billion a month. And I think any impact on stocks and shares is already priced in. Yellen doesn't strike me as a radical revolutionary, so I suspect we'll see little further tapering during 2014, as the powers that be in Washington surely understand how fragile the recovery remains. And let's not forget something that you never hear in the mainstream media. While the new monthly number has been reduced by 10 billion, all the previous trillions of dollars birthed by Bernanke's overactive mouse in the last 5 years are still contributing interest to the economy. So the net effect is still a stimulus to markets. This begs the question how much further stock prices can rise. The US stock market has doubled in 6 years and now looks a bit expensive. There's probably still some growth left as QE continues, but it's hard to see things doubling again from here. I've got quite a bit of exposure to the US stock market at the moment, and I'll be looking to progressively reduce that as the year goes on. If we've learned anything in recent years, it's the direct correlation between money printing and rising share prices, which suggests that markets that are earlier than the US in the QE cycle have got more growth left in them. That immediately points us to Japan, where Abenomics has really taken off in the last 12 months. He's now printing almost as much money as the Fed in an economy half the size. It all feels a bit uncomfortable because we're making investment decisions based on the whims of politicians and central bankers. The big problem with QE is that fundamentals no longer apply. It's really hard to know the fair price of assets when the money supply is being so deliberately distorted. But if you'd taken a purist view and stayed out of the markets these last few years, you'd have missed out on huge growth. Even long-term bears are reluctantly turning into bulls in this market. The question no one can answer is, when will the party end? Tune in next week for part 2, but for now, be careful out there.